Want to start investing but not sure where to begin, especially in 2025's fast-changing financial world? Whether you have $50 or $5,000, this guide will show you exactly how to start building wealth from the ground up. Before we break down the smartest beginner-friendly investing moves, be sure to like this video and subscribe, because your journey to financial freedom starts right here. Let's get into how to invest in 2025, even if you're starting with zero experience. Why start your emergency fund first? Before you invest a single dollar, you need an emergency fund covering 3 to 6 months of expenses. This isn't just financial advice. It's your safety net that prevents you from selling investments during market downturns. Keep this money in a high-yield savings account earning 4 to 5% APY. Without this foundation, you'll be forced to liquidate investments at the worst possible times, turning temporary market dips into permanent losses. Understanding your risk tolerance and time horizon. Your investment strategy should align with when you'll need the money and how much volatility you can stomach. Money needed within 5 years belongs in safer investments like CDs or treasury bills. For long-term goals like retirement, you can handle more aggressive growth investments. Take an honest assessment of your emotional response to losing money. If a 20% portfolio drop would keep you awake at night, start with more conservative allocations and gradually increase risk as you become comfortable. Index funds, your best friend as a beginner. Index funds are the simplest way to achieve instant diversification across hundreds or thousands of companies. A total stock market index fund like DTSAX or VTI gives you ownership in virtually every publicly traded U.S. company. These funds typically charge fees under 0.1% annually and have consistently outperformed actively managed funds over decades. Start with broad market index funds before considering sector-specific or international options. The power of tax-advantaged accounts. Maximize tax-advantaged accounts before investing in taxable accounts. If your employer offers a 401 match, contribute enough to get the full match. It's literally free money with an immediate 100% return. Roth IRAs are perfect for beginners since contributions can be withdrawn penalty-free, and all growth is tax-free in retirement. In 2025, you can contribute $7,000 to a Roth IRA if you're under 50. These accounts compound tax-free for decades, creating substantial wealth over time. Dollar cost averaging, your automatic wealth builder. Instead of trying to time the market, invest a fixed amount regularly regardless of market conditions. This strategy, called dollar cost averaging, automatically buys more shares when prices are low and fewer when prices are high. Set up automatic investments of $200, $500, or whatever you can afford monthly. This removes emotion from investing and builds wealth consistently. Markets go up and down, but this strategy smooths out the volatility over time. Common beginner mistakes to avoid. Don't try to pick individual stocks until you understand the basics thoroughly. Avoid cryptocurrency as your primary investment. It's speculation, not investing. Never invest money you'll need within 2 years, and don't panic sell during market downturns. Ignore financial media that creates fear and urgency. Successful investing is boring and consistent. Most importantly, don't wait for the perfect time to start. Time in the market beats timing the market every single time. Building your first portfolio. Start simple with a 3-fund portfolio. 70% total stock market index, 20% international stock index, and 10% bond index. As you learn more, you can adjust these percentages based on your age and risk tolerance. Younger investors can handle more stocks, while those closer to retirement should increase their bond allocation. This basic allocation provides global diversification and appropriate risk management for most beginners. Choosing the right brokerage. When selecting a brokerage, it's important to find one that aligns with your financial goals and makes investing simple and affordable. Choose a platform that offers zero commission fees on stock and ETF trades. This ensures more of your money goes toward investments instead of fees. Trusted firms like Fidelity, Vanguard, and Charles Schwab are excellent choices. They not only offer commission-free trading, but also give access to low-cost index funds, which are ideal for long-term, diversified investing. Beyond cost, consider the usability of the platform. Look for a clean, intuitive interface that's easy to navigate, especially if you're new to investing. A good brokerage will also provide robust educational tools, including videos, articles, and calculators, so you can learn as you grow. Strong customer service is another plus. You'll want to reach someone quickly if any issues arise. Many of today's top brokerages now support fractional share investing, which allows you to invest small amounts, like $5 or $10, in expensive stocks. This makes it easier to start building a portfolio without needing a large upfront investment. Finally, avoid brokerages that charge account maintenance fees, inactivity fees, or require high minimum balances. These unnecessary costs can slow your progress and make it harder to grow your investments over time. Setting realistic expectations. The stock market has historically delivered average annual returns of about 10% before inflation, but these returns can swing widely from year to year. In some years, your investments might grow by 30%, while in others, you could face losses of 20% or more. These fluctuations are normal and part of the investing journey. What truly matters is staying invested through all market conditions, good or bad. Trying to time the market or chase quick gains often leads to poor results. Instead, focus on making consistent contributions, no matter the market environment. Building wealth is a slow, steady process that requires patience and discipline. Even legendary investor Warren Buffett, considered one of the best of all time, averages around 20% annually over decades, not every year. Rather than aiming for unrealistic returns, commit to the long-term strategy and let time and compounding do the heavy lifting. Taking action, your next steps. Take a meaningful step towards your financial future this week by either opening a Roth IRA or increasing your 401k contribution, depending on what's available to you. These retirement accounts offer major tax advantages and are essential tools for long-term wealth building. After that, select a broad market index fund, such as one that tracks the S&P 500 or total stock market, which provides instant diversification and typically comes with low fees. Set up automatic monthly investments, starting with whatever amount feels manageable, even if it's just $50. Over time, that small, consistent contribution can grow into tens or even hundreds of thousands of dollars thanks to compound interest. To deepen your understanding, read a reliable and beginner-friendly book like The Boglehead's Guide to Investing, which simplifies the world of personal finance and investing. Gaining this knowledge will help you feel more confident and avoid common mistakes. But above all, don't wait until you feel completely prepared, because the perfect time to start rarely comes. The most powerful move you can make is to begin now, even with a small step. Time in the market matters far more than timing the market, and the earlier you start, the more your money can work for you. Investing doesn't have to be complicated, just consistent. Start small, stay informed, and let time do the heavy lifting. If this helped you feel more confident about getting started, hit like, subscribe, and drop a comment with your biggest investing question. We just might cover it next.